Friends, good evening. I am going to cover you new strategy. This is again option strategy. Strategy name is covered put strategy. The cover let's go ahead. What is covered put? So covered put is a trading strategy that uses option to try and profit if a stock has been short, short shouldn't drop price. A trader will short sell stock if he expects a drop in share price. But there may be periods when things the price is likely to stay stable for a period of time, i.e. they have natural outlook because their short position won't return any profit if there is no price drop. Alternative actions are required to try and make some money. This is where the covered put comes in. It involves writing put options with the expectation that they will expire worthless and it will provide some profit. We should point out that in this isn't a commonly used strategy and its one should be considered a very precise conditions or circumstances. We have provided more detail as below. So let's why we are using covered put. We must understand the covered put is a class as a neutral strategy because its main purpose is to try and profit from the stock that doesn't move in a price over a period of time. It would be used if you have an open short stock position and you believe that the price of the relevant stock is about to go through a period of stability and it's not likely to move. You could simply close your position, but if you want to keep it open in belief that it will go down in long run, then you covered put offers a way potential make return during the period of stability. It will offer you some low level protection if the price of the short sold stock went up unexpectedly. So you see the figure, this is the diagram of cover put. Then again profit and loss is there, then share price, and you see the break even point. Once it goes down, you will get the break even point. So strike price is there, then break even point is there. So you can correlate this. How we can implement the cover put? Implementing the covered put is a very straightforward process. All you have to do is write enough puts using the sell open order to cover the amount of stock that you have short sold. You will need to make two specific decisions and they are what expiry date to use and what strike price to use. These decisions ultimately depend upon your expectation are and what you are trying to achieve. You should use the expiry date that is appropriate for how long you think that the stock will remain stable. If you think it will stable for a prolonged period of time, then you should write contract with a long term expiry date. If you think it will be stable only short period, then shorter term expiry date is appropriate. In terms of the strike, we would generally recommend that you write contracts that are at the money or just out of money. You can use the lower strike if you wish, but you will not receive a less of credit and those contract will be cheaper. Below we have provided example and how you can use a covered put. So let's say you have a short sold 100 share of a company X stock which is currently trading as rupees 50 we shall refer to this price as a starting point. You believe that the price of the stock will remain relatively stable for a short period of time, and you want to try and profit from the stability. You write one contract of put options. Each contract contains 100 options that are out of the money, 49 strike and expiry end of following month, a net credit of rupees 150 1.50 per option. Potential profit and losses. The ideal scenario for you is that the price of stock drops from 50 to 49. You will give you this will give you 1 rupees profit per share. You have a short sold, and also means that you have written will expire at the money worthless. The net credit of 150 rupees you receive, writing those with a total profit of 250. This is most you will be able to profit through, because the price goes any lower than any additional profit you make, the original position will be offset by the put option that you have written. If it fall below 49, put will move in the money and could be assigned, which would force you to buy the stock at rupees 49 strike. You would also make a profit if the price stayed at exactly rupees 50 or drop it to somewhere between 49 and 50. The put would expire worthless and profiting you rupees of 150. The biggest risk that the price could increase significantly amount. If this happens, your short stock position will start to lose your money. Any losses will be offset by 150 credit receiving writing put. These will expire worthless any time the share price is above 49. But if the share price went up dramatically, that would only cover the fraction of your losses. The potential profit and the losses can be summarized as below. You just see. So maximum profit is made equal to price of underlying stock equal to strike of options. Profit is made when the price of underlying stock is greater than or equal to starting point but less than strike price of the option. Price per share sold is equal to starting point minus price of underlying security plus price per option. This profit is calculation does not apply if the price of underlying stock is less than the strike price of option. Profit per share sold when the price of underlying is less than a strike price of option is starting point minus strike price of option plus price per option. What is break even point? Price of underlying stock equal to starting point plus price of option. Losses are unlimited when underlying stocks move between the break even point. Losses share short sold are prices of underlying minus starting point plus price of option. It has been suggested by that some profit from the fall in the price stock or losses made a rise in the price shouldn't included, because those profit or losses will be made from the original position whether a covered put is used or not. However, we have included them that the calculation are accurate for the whole position. The calculation don't however take into account any profit or losses made on the original position prior to applying covered put. They also do not take into account commission cost. So let's go ahead summary. The covered put can be effectively way to profit from short strike position when your share price is stable for a period of time. However, it does limit your potential profit should the share price fall, and it's very limited production should increase. As such, there is a trading strategy you should be considered if you are confident about the share price will relatively neutral for the relevant period of time. So this you must know. So I friends, I have covered the cover put strategy. I have told what is covered put, then where to use, then its application, then how to calculate maximum profit, break even point, losses, then summary. So friends, this you can use this strategy options. I will request you to subscribe video. In case you're not done, always press the bell icon and share to friends because they might be playing in options and they are not aware of this strategy. Please remember, there is no strategy single call or put. They are payoffs. Don't use them as independently. So this option is always hedging. Options is used for hedging the position. So this is what from my end. Thank you. Thanks a lot. Good night.